The price didn't drift, it was forced down again. And what you're witnessing right now isn't a typical rally or a regular pullback. This isn't a standard market cycle. What you're seeing is the final scene in a decades-long price suppression play. With precious metals beginning to falter out in the open, silver is caught in a tug-of-war, like a hostage. One group is pressing it beneath a psychological barrier, while the other is pulling physical supply out of the system faster than paper contracts can fake. Here's what really matters within the first few seconds. If the largest commercial players weren't suppressing silver through paper instruments, its price would already be above $100. Not at some point in the future, right now. Welcome to the channel that cuts through the noise and breaks down what's really happening in the metal space. Let's begin with an uncomfortable truth. The number on your screen is not the real price of silver, it's the valuation of over-leveraged paper promises tied to silver. That figure is produced in the most hyper-financialized corner of the system, where volume is enormous and accountability is minimal. For years, that paper-based price was enough to keep the illusion going. Contracts are dumped during low-volume windows. Bids are pulled, the ladder is spoofed, charts are slammed, stops get triggered, headlines do the rest. This strategy became so predictable, it felt like a law of nature. But nature is changing. The same attacks still occur. You'll still see selling pressure show up in illiquid moments, overnight sessions, foreign trading hours, thin markets, where a small push can create a large visual effect. The real shift is what follows. 2 decades ago, a chart slam could hold for weeks. Now, it's undone within hours, sometimes within 30 minutes. That's not normal volatility. That's a breakdown. That's the system replaying its old tricks while the crowd finally sees the strings being pulled. Why now? Because the world in which this scheme was originally crafted doesn't exist anymore. Trade patterns have evolved. Manufacturing centers have shifted. Populations have grown. Energy policy has been rewritten. Most critically, the flow of physical metal has changed. Holding down prices for 50 years has had one clear consequence: strangled supply expansion. Keep any resource artificially low for long enough. And the outcome isn't a production boom, it's stagnation. Projects stay unfunded. Mines shut down as their ore quality drops. Exploration dries up because no one invests when returns are crushed by managed prices. Meanwhile, demand kept climbing. Then the modern phase arrived: electrification, industrial build-out, strategic accumulation, and a global base of investors who finally asked a simple question: do they actually possess the metal? That question is devastating to a paper market. Paper can simulate endless supply until someone demands physical delivery, pays a premium to hold real metal, or when an exporter simply refuses to ship. And that's exactly what this moment feels like. Silver keeps rising, even as the system unleashes every tactic it has to slow it down. You can sense it in the tape, you can feel it in the timing, you can see it in how the market bounces back after every blow. Those repeated clashes around clean price levels aren't mystical forces at work. That's psychology, that's trader positioning, that's risk control in action. But beneath all the theatrics lies a more fundamental truth. The market is being dragged toward genuine price discovery. And real discovery is ruthless. It doesn't care about your storyline. It ignores media spin. It has no use for tidy charts designed to keep the masses calm. The only thing real discovery demands is physical availability at the stated price. If the price isn't real, the metal vanishes. And when the metal disappears, the so-called price must adjust. Now take a step back and observe the pivot that's cracking the old system. Demand is becoming rooted in physical strongholds, not in Western financial echo chambers. The West may still dominate with its massive derivative markets and powerful financial news outlets, but the East controls the factories, the refineries, the cultural bias toward tangible wealth, and increasingly, the confidence to say, deliver it or move aside. That's why talk of persistent premiums, supply tightness, and availability gaps keep surfacing even when it doesn't align with the smooth tone of mainstream reporting. The size of the premium isn't the headline. The fact that it won't go away is. A premium that lingers sends a clear message. The physical metal simply isn't as available as the paper price suggests. And the longer that gap holds, the more the market begins to learn a risky truth. The paper price is optional, and once any commodity accepts that, the leverage game falls apart. Silver doesn't exist in isolation. Pressure is spreading across the entire complex: gold, platinum, and key industrial metals. The signs are all there: large, focused positions, bursts of forced buying, and erratic price behavior that looks less like strategic investing and more like urgent survival. Short covering isn't normal buying behavior. It doesn't care if the asset is undervalued or overbought. Its only goal is survival, closing the position before it becomes catastrophic. That's why sharp, rapid price moves in tight metals are a red flag. They aren't just volatility, they're evidence of stress. And when those signs appear while physical supplies are tightening, the old balance starts falling apart. Now, here's where things get chaotic, and this part is vital. When the old structure begins to break, misinformation spikes. You'll start seeing AI-generated videos, viral claims that secret exchange rules were activated, clickbait countdowns to collapse, and fake quotes from famous names urging you to panic, sell one metal, and hoard another. This isn't just background noise, it's a deliberate tactic. When pressure builds, the incentive to manipulate public sentiment skyrockets. If the system needs liquidity, it will attempt to stir emotion. That's why you need a simple filter. If something is legitimate, it can be confirmed. Look for regulator announcements, exchange documents, rule updates, and official press releases. Not grainy videos, not dramatic voiceovers, not bold text on screenshots with no source. If someone said it on a platform, treat it like gossip until it's verified. Why? Because the most effective way to shake people out of a genuine move is by flooding the space with manufactured certainty. That false certainty leads to panic selling. Panic selling generates liquidity, and liquidity is the lifeblood of a system under pressure. Now, let's shift to structure, because structure is what holds firm when the noise rises. Silver has been in a prolonged supply-demand imbalance. This isn't about a short-term headline or a seasonal fluctuation. It's been a multi-year, persistent, compounding deficit. When any commodity is short on supply, the system draws from reserves, inventories, vaults, and above-ground stockpiles. These buffers delay the appearance of a crisis. But once they start running low, the only tool left to restore balance is price. And once price is unleashed, it rarely stops where analysts predicted. Some still cling to old charts as templates, but today's landscape is vastly different. Industrial demand is stronger. Global supply chains are more brittle. Government policy is more hands-on. And the base of serious physical buyers is larger and more globally distributed. That combination spells trouble for long-term price suppression. So here comes the obvious question. Can't exchanges or regulators just step in and adjust the rules? They might try, but there's a cost. If a market enforces cash settlement during a time of physical scarcity, it doesn't solve the problem, it reveals it. When a trading venue is seen as unable or unwilling to deliver the actual commodity as promised, confidence collapses, and you can't patch that kind of damage with a press release. You restore trust with physical delivery. And when metal is actively being funneled into industrial use, refining centres, or strategic stockpiles, rebuilding that trust becomes a slow process, right when the market is most fragile. That's why the next stage is risky, not only because prices may spike, but because confidence can break. A confidence break is when the conversation shifts from what's the price to will it be available when I need it. Now add another layer, one that most people overlook, policy friction. When a major producer or refining country tightens export requirements, licenses, approvals, quotas, paperwork, it doesn't take a dramatic ban to change the rules of the game. Even light friction is a hit to availability, and availability is what props up paper market credibility. Thin inventories are when paper promises start to feel hollow. This is how materials shift from economic inputs to strategic assets, not because of flashy headlines, but due to real-world constraints. When governments and major industrial consumers start treating a metal as vital, it stops acting like an optional luxury and starts behaving like a non-negotiable supply chain priority. In that scenario, the buyer who needs it will pay whatever it takes. That's the moment price control shatters, because price control depends on flexibility and demand. And when demand becomes inelastic, paper schemes lose their grip. So what can the average person do about all this? You don't control macro policy, you don't run the exchanges, you don't influence regulation, but you do control your position. Step 1, secure physical metal while it's still accessible. Although silver is still widely accessible for now, there's a scenario, call it extreme if you like, where industrial and strategic demand swallows enough supply that retail access becomes sporadic, then scarce, and eventually rationed by premium levels. We've already witnessed early signs. Spot prices appear stable, yet product delays are common. Premiums stretch wider, and sold out becomes the new norm. That's not a conspiracy, that's logistics running into real-world constraints. Now, the second lever, producer exposure, may be an option if you've got the appetite for risk, but don't go into it blindly. Investing in miners is far from a simple silver up, stock up formula. There are multiple landmines: operational risk, political risk, financing gaps, shareholder dilution, and perhaps the most dangerous, hedge books. If a miner sold future production at lower prices, they could completely miss the upside while the metal soars. The bank profits. The investor watches. So, if you take this path, Know what you're buying into, and if you're not willing to do the research, don't pretend otherwise. Use diversified exposure instead of going all in on a single narrative. Now, be honest with yourself, this answer shapes how you'll respond the next time the price chart takes a hit. Are you here to scalp candles or to get ahead of a system-wide reset? If you're trading short-term moves, volatility will grind you down. That same volatility that scares off weak hands is designed to punish the impatient. But if you're positioning for a reset, the noise fades into the background. The thesis either holds or breaks based on two key factors: continued physical tightness and the shrinking effectiveness of paper suppression. Both are happening right now. Let's talk about what real failure looks like. The old strategy was pure psychological manipulation. Hit the market during illiquid hours, break the chart, trigger stop losses, and let headlines declare a peak for years. That approach worked because it damaged confidence long enough for price to stay down. But take a look at what's happening now. The same paper dumps still arrive at the usual dead hours, but the market snaps back immediately, almost as if insulted. That's the signal. Dips are being treated like buying opportunities, not warnings. And when pullbacks become discount windows, suppression flips into self-inflicted damage. Now add what's unfolding in plain view: massive physical drawdowns. There have been recent days when a single silver fund reportedly absorbed tens of millions of ounces. That's equivalent to several days' worth of global mining output funneled through one channel. But mines don't speed up because an ETF had a strong inflow. Refineries can't magically expand capacity overnight. So, this concentrated demand isn't just impressive, it's putting pressure on an already overstretched system. This pipeline is already operating at full throttle. We're deep into a long-standing supply-demand imbalance in silver. This isn't theoretical, it's ongoing. Global silver mining produces several 100 million ounces annually. Recycling adds a bit more, but demand keeps climbing. And when that happens, the system keeps functioning only by draining inventory. Vaults and stockpiles pick up the slack until they run dry. This is the exact moment price control systems dread because they rely on cushion. Without that buffer, every upward move lands harder, every paper takedown faces resistance more quickly, and what once looked like brief shortages starts to resemble long-term scarcity. Now, this stops being just a story about markets and becomes a strategic story. Silver isn't some luxury add-on, it's a vital industrial resource. And when crucial resources tighten up, governments stop acting like bystanders. They don't shrug and say, "Let the free market fix it." They say, "Prioritize." And prioritization means allocation. Allocation requires rules, and those rules often start subtly, showing up as paperwork, not press conferences, not press. That's why it's critical to watch what major producers or refining hubs are doing. If they start tightening export approvals, imposing licensing requirements, or adding red tape, that's not noise, that's friction. And friction is the first attack on availability. And it's availability that keeps the paper market believable. If you've watched how other strategic materials get used as leverage in global negotiations, you already know this playbook. A country doesn't need to impose a full export ban to gain influence, it just has to make supply less dependable. And if a major region begins requiring export licenses starting in early January, that's not some footnote, it's a stress test. It forces downstream players to ask a question they've been avoiding. What if the metal isn't there when we need it? Now stack that on top of a topic often whispered about but rarely modelled publicly. What happens if a large paper market tries to resolve a shortage with cash? In stable times, cash settlement is boring. In tight markets, it's a red flag. If real metal is scarce and the system forces cash instead of delivery, the signal is obvious. Paper contracts are not equivalent to physical metal. And once that belief spreads, the whole structure of pricing begins to shift. You don't restore credibility in commodities with statements. You rebuild it with physical fulfillment. So if you're waiting for a smooth and orderly transition, don't. Transitions like this are chaotic by design, and that's why, alongside the market battle, you'll also see an information war unfolding. AI-generated content, deepfake videos, rumors of secret rules, dramatic countdowns to collapses, fake headlines telling you to dump one asset and grab another. None of that is accidental, it's coordinated. When pressure builds, so does the desire to shape public emotion. If the system needs liquidity, it'll manufacture fear and confusion. That's why you need a simple reality check. If a claim would shift the entire market, you'll find it in primary sources. Official bulletins, regulator reports, exchange announcements, press releases, not low-res screenshots, not mystery voiceovers, not bold font panic posts. Treat all else as speculation until proven otherwise. So what can a regular person actually do about all this? First, Let go of the idea that you can just buy it later at spot. That assumption is the first to die in a real physical squeeze. Physical isn't a trade, it's a position, if you want it. Lock it in while supply channels are still operating normally. Second, take volatility seriously. The closer we edge toward real price discovery, the more aggressive the moves will be. Volatility isn't random, it's how the unprepared get flushed out. If you're using leverage, a fast move becomes a forced liquidation, and forced exits are how wealth changes hands. Third, if you're considering exposure to producers, you need to recognize the minefields, political risk, funding challenges, shareholder dilution, and especially hedging practices. A producer that locked in low forward prices might completely miss the upside while the metal surges. Don't make the mistake of thinking every mining stock is a direct stand-in for silver. Fourth, prepare for distraction. When a distortion that's lasted for a decade or more begins to unravel, the narrative won't be "we manipulated prices." The mainstream story will be something else: conflict, supply chain breakdowns, emergency policy shifts, anything but the obvious. Major price moves will hit the tape, but the headlines will point to a different cause. That doesn't make those stories true. It makes them convenient cover. Now here's the real cliffhanger. When silver crosses into triple-digit territory, it no longer feels like a speculative trade. It becomes a statement, a referendum on the very system that kept it priced lower for decades. At that point, the pressure shifts. It's no longer just about traders, it's about policymakers. And that's when rules can change at lightning speed. So I'll leave you with two questions, and I want your answers in the comments. What breaks first? Physical supply or paper trust? If silver hits $100, what comes next? Greater market freedom or increased restrictions? Drop your thoughts below, and if you want to follow this play out in real time, make sure you're subscribed, because this isn't just market movement anymore. This is the system telling the truth.